Hello, dear viewers of Forexer. In today's video, we're about to embark on an exciting journey as we delve into a comprehensive, rules-based day trading strategy. This strategy has proven its mettle in the Forex, cryptocurrency, and stock markets, making it an excellent starting point for beginners or traders who may be grappling with the challenges of the market and are yearning for a reliable edge to consistently generate income. This price-action trading strategy seamlessly blends fundamental concepts such as market structure analysis, pullbacks, and advanced candlestick entry setups. If this sounds intriguing and promising to you, as it surely does, please take a moment to express your support by hitting the like button. And for those of you who are new to our channel, we extend a warm invitation to subscribe because we regularly share invaluable insights into advanced trading techniques. Thank you for joining us today, and without further ado, let's dive into this exciting exploration. Like I mentioned earlier, this price-action trading plan is a pullback trading strategy that skillfully combines multiple market structure factors with the utilization of an advanced candlestick pattern as our entry rationale. It's important to note that this trading setup is versatile and can be applied across various time frames, but our preferred time frame for its implementation is the 1-hour chart. What sets this strategy apart is its adaptability across different markets. Whether you're trading stocks, cryptocurrencies, or currency pairs, this approach can be effectively employed. The pullback trading strategy falls under the category of trend continuation setups, and it comprises two distinct trading models. Additionally, we employ two advanced candlestick patterns for our entry points. While these patterns may appear quite similar, the underlying psychology driving them differs slightly. In essence, this trading strategy is meticulously designed to seize opportunities within impulsive moves that occur during periods of high volatility within trending markets. So, without further ado, let's delve into the steps and rules. This strategy comprises 3 key steps in both trading models: identifying the market direction, waiting for a pullback, and finding an entry reason. Let's begin with the first step: identifying market direction. In this step, we utilize a straightforward concept to determine the market direction, as our objective is to align our trades with the dominant side of the market. To achieve this, we employ the exponential moving average, EMAE. Here's how it works. We place the 50 EMA on our chart and patiently wait for the price to breach it in either direction, establishing a new high or low. This breach allows us to discern whether we are in the midst of a bullish or bearish market phase. For instance, in the example provided, the price has successfully broken above the 50 EMA and surpassed the previous market structure to the upside, creating a fresh high. Consequently, we've identified a bullish market. With this direction now clear, we can proceed with the subsequent steps, seeking long trading opportunities. In this bearish scenario, the price has broken below the 50 EMA, which has resulted in the formation of a new market structure distinct from the previous one. Consequently, our trading direction is bearish, and we should actively seek short trading opportunities. Aligning our trades with the dominant trend can yield an instant improvement in our win rate and risk to reward ratio. Now that we have a clear understanding of how to identify the market direction, let's proceed with the second step, waiting for a pullback. There are numerous methods that traders employ to identify a valid pullback. However, the rules we follow for this specific trading setup are quite straightforward. We patiently wait for the price to display a minimum of 2 candles with colors opposite to the preceding ones after an impulse, indicating the initiation of temporary correction phase. The same concept applies to the bearish scenario. To confirm the pullback, we require a minimum of 2 white candles. Waiting for a pullback optimizes our entry, enabling us to get in at a more favorable price and capture maximum profits. The third step involves making the entry. What we have discussed in this video so far pertains to market conditions. We have examined the market trend to align ourselves with the dominant side, identified pullbacks as opportunities to enter at more favorable prices, and used market structure to confirm our analysis. Now, in addition to these conditions, what we require to formulate a complete strategy are entry signals, precisely when to enter a trade, and exit criteria, both for when we are correct and when we are not. Now, we utilize two candlestick patterns as our entry signals to anticipate the conclusion of the pullback and the initiation of an impulsive move. These reversal candlestick patterns are, in fact, advanced engulfing candlestick patterns. The engulfing candlestick formation stands as one of the most potent price action reversal patterns, a pattern that I'm sure you're all familiar with. This pattern comprises two candlesticks, with the body of the second one having the opposite color and completely encompassing the body of the first one. However, to use the engulfing candle as our entry signal for the pullback strategy, it must adhere to certain rules. In the first pattern, the green candle's body must be larger than the red candle, signaling a change in color. Additionally, the green candle should have a lower low than the previous candle, indicating that it also serves as a swing low. In this scenario, this becomes our actual entry point for the pullback trading strategy. We will enter the trade at the close of the green candle and set our stop loss just below it, aligning with the latest swing low. Now, let's move on to entry number 2. The second engulfing pattern closely resembles the first one. It features a body with the opposite color closing above the first one. However, in this case, the green candle may not necessarily be a swing low, but we can still use it as our entry signal if the red candle has formed a lower low than the previous candle. Essentially, this means that the second engulfing entry pattern also establishes a swing low. The same concepts apply to the bearish scenario. So let's delve into it. In entry number 1, we're dealing with a bearish market characterized by an impulsive move, followed by a pullback. In this setup, we seek an engulfing candle with a color change and a larger body that establishes our swing low. Subsequently, we can enter the trade at the close of this candle and position our stop below the swing low. Similarly, in the second pattern with the market exhibiting the same impulse and correction, a red engulfing candle appears, and the green candle forms a new lower low, constituting a fractal move. These are the only two entry signals we will employ. Anything else would not qualify as a valid entry. Now, let's consolidate our understanding with some actual chart examples. We're looking at a bullish market on the pound-yen 1-hour chart. The price is trading above the 50 EMA, and we spot the 2 candlestick pullback. In this scenario, all we need to do is patiently wait for the market to display our candlestick entry patterns to initiate a long position. We've identified a valid entry reason, so we will open a buy position, place our stop below the engulfing pattern, and set a target at 2 times our risk. The appearance of the bullish engulfing candle signifies a bullish reversal, indicating an increase in buying pressure when it emerges at the bottom of a pullback. This approach, when combined with the right market conditions, provides a highly accurate way to enter the market. The same principles apply to the bearish scenario. We aim to observe the price trading below the 50 EMA, followed by the price printing 2 bearish candles, which we interpret as our pullback movement. Subsequently, we patiently await the price to present one of our advanced engulfing candlestick patterns to confirm our entry into a short position. Our stop will be positioned just above the swing high, and we will set our target at 2 times our risk. Now, this concludes the discussion of the first trading model. Let's proceed to the second one. But before we do, as always, please consider hitting the like button to support our team in producing more videos. Additionally, feel free to comment below and let us know if you'd like to see more videos on price action or smart money concepts. This trading setup mirrors the first one with 2 significant distinctions. Similar to the first step, In the bullish scenario, we seek the market to be trading above the 50 EMA and to establish a new high. Then, we anticipate a 2-candlestick pullback. However, the difference here lies in the requirement that the pullback must touch the 50 EMA. This means that the pullback needs to retrace all the way down to the 50 EMA and span at least 2 candles. Now, there's an additional rule to consider. Once we reach this point, we want to witness the price being rejected from the EMA. This rejection can manifest through wicks, or we may observe just one candle closing below the 50 MAA. Crucially, the price must promptly return within the range. If this does not occur, the trade will be deemed invalid. Following this type of pullback, we can proceed to place the trade based on the engulfing candlestick pattern we discussed earlier. As you can see, creating these specific rules for entering the market based on conditions and entry reasons, as demonstrated, ensures your trading approach is rule-based and not subjective. Documenting all these rules and adhering to your trading plan will provide precise guidance on how to execute trades when opportunities arise, simplifying your trading process. And simplicity is a key element in achieving profitability. Now, there's one crucial concept remaining before executing a trade based on this strategy, and that's analyzing the market structure. This trading strategy is designed for trend continuation, so it's imperative to stay vigilant for any reversal signals the market might present. There are 2 categories of market factors that demand our attention in this regard. 1. Higher time frame key levels. These are significant price levels on higher time frames that could act as potential reversal points. Traders should be aware of these levels and exercise caution when approaching them. 2. Reversal chart patterns. Keep an eye out for reversal chart patterns that could indicate a potential change in the market direction. Recognizing patterns like double tops, head and shoulders, or triple bottoms can be vital for assessing market sentiment and potential trend reversals. Being mindful of these market factors will help us make informed trading decisions within the context of this trend continuation strategy. Before placing any trade, we should check how much room we have before reaching the higher time frame key level. This consideration is crucial because even a small reaction to these levels can result in a major trend change in the lower time frames. Therefore, we only enter the market if we have sufficient space before reaching the next level ahead of the current price. This concept will help us avoid losing trades and capture excellent risk. 2. Reward ratios. In essence, combining multiple time frames will help you achieve a clear and well-informed chart analysis. The second market factor to consider is reversal patterns. Reversal patterns are chart formations that indicate the current trend is likely to reverse its course. When a reversal pattern appears during an uptrend, it signals that buyers are losing momentum and sellers are gaining control, and vice versa. Among the most commonly observed reversal patterns on charts are double tops, double bottoms, and fakeouts. When these patterns emerge on the chart, it's prudent to approach continuation setups with greater caution. As usual, let's open the TradingView chart to walk you through step by step what's going through our minds when trading opportunities arise. Here, we're looking at the US 30 on the 1-hour time frame. The price has recently broken below the 50 EMA, establishing a new low, which indicates a bearish bias. But before we commence the chart replay to identify potential short opportunities, let's examine the higher time frame to gain a broader perspective. Here, on the 4-hour chart, we can observe that we've reached a significant key level that holds the potential to act as a turning point for the price. The market has robustly rejected this area on multiple occasions in the past, even forming a double top pattern, which serves as an additional reversal signal. So, once again, we affirm our bearish bias, this time on the 4-hour chart. With this broader perspective in mind, we can now focus on capturing short opportunities on the 1-hour chart. Our target would be the key level within the market structure that has consistently repelled the price on multiple occasions. Let's return to the 1-hour chart to continue our analysis. The direction is bearish. Let's move forward and wait for a pullback formation. We observed two bullish candlesticks, confirming the pullback. Now, what we're looking for is the price to continue trading below the 50 EMA and form an engulfing candlestick pattern for our trade entry. The market has indeed printed our first engulfing candlestick pattern, providing our entry reason to go short. We open a short position, place our stop above the swing high, and set our target at twice our risk. We identify another valid engulfing pattern, so we open another short position. Here, the market experiences a deep retracement and rejects the 50 EMA, aligning with our second trading model. Unfortunately, we miss this trade as we don't have our engulfing candlestick entry signal. We encounter another potential entry setup, but the issue is that we've reached our higher time frame key level. Thus, we must wait and see how the market behaves next. We check the 4-hour chart again to gain a better understanding of the situation. On the 4-hour chart, we notice that the price is within a strong demand area. We outline two high probability scenarios. If the price manages to break below this level, we can expect it to fall to the next support area. However, if the price returns within the range, we can anticipate a rise with a long-term target at a key area. Returning to the 1-hour chart, we see that the market has reversed and broken above the 50 EMA. We wait for the price to confirm the bullish direction by making a new high and look for a pullback. We spot a valid pullback and our first engulfing entry pattern for a long position. Accordingly, we open a long position. Properly backtesting your trading setup is essential. Remember that no trading strategy is flawless, and during your backtesting, you'll encounter many losing trades. Always maintain a sound risk management plan to stay in the game. So that wraps up this video. I hope it has been valuable to you. If it has, please show your support by liking the video. And if you're new here, consider subscribing to our channel. See you in the next episode.